I'll move us on to M&G, which is something I don't think we've spoke about at all on the podcast, Steve. I can't remember bringing it up, but we're going to cover another kind of company in the sector a little bit later. So I thought it was probably worthwhile that we do this one as well, as its earnings were out just this morning. So I've had a good dig through them. Ticker is M&G, and it's a 6 billion or a 6.2-ish billion investment manager essentially now on the London Stock Exchange, constituent part of the FTSE 100. A big dividend payer, and if you look back over the last 5 years, Steve, it's done about 63% over the last 5 years. However, if you just looked at the last 4 years, it's done about 8%. But that's not to be sniffed at, because the dividend yield has been between sort of 6 and 9% during that period, 6 and 8%. So even with 2%, you're getting a 10% return, which hasn't beaten the S&P, but is very decent. Obviously, when you're benchmarking, it is sad when you don't beat the S&P, but it's always good when you get a 10% return, and that's what M&G has been giving people on an annual basis. So yes, it's a leading player in UK's savings and investment market. It helps individual savers and large institutions and everybody in between, pension funds, businesses, grow and manage their money for the future. It's essentially a financial services powerhouse that has two kind of engines to it: asset management and life. So the asset management business is about managing money for external clients. It's basically investing in everything from stocks, bonds, more complex assets, private assets. This is essentially what they would describe as their growth engine. The life business is focused on more long-term savings, retirement products, has a unique fund called the Pru Fund, which is because M&G was a demerger from Prudential originally. But essentially, this fund is designed to smooth out the ups and downs of the markets, giving investors consistent returns over time. It's what they would call their key differentiator. I would call it nonsense. So key metrics for them is obviously the same with all these kind of things. It's kind of assets under management, assets under administration. It's essentially the total value of the assets that they manage on behalf of their clients. And a higher AUMA in these kind of companies leads to higher fee income. And the AUMA, the assets under management and administration for M&G, is about 355 billion. So fairly sizable. So on to the half for 2025. Basically, M&G is in the middle of a turnaround strategy of sorts, and it looks like it's maybe beginning to get a bit of traction. The numbers tell a story of a company that has had outflows, but now has managed to stem them and is returning to basically growth in those numbers. So net flows from open business, this is, I would say, one of the most important metrics for an asset manager. It basically tracks the difference between money flowing in from new and existing clients and money being withdrawn. And M&G saw positive news this time around with about 2.1 billion of net inflows, which is a pretty dramatic improvement from 1.1 billion of net outflows in the same period last year. Positive momentum was pretty much driven by this asset management business. 2.6 billion inflow from external clients shows that their investment strategies and products seem to be kind of resonating with the market at the moment. The operating profit before tax, which had a star next to it, it was adjusted. But this is essentially a measure of the profit from their core operations before accounting for one-off items. So this figure was about £378 million, a slight increase from 375 million a year ago. I think it's a sign of the core of the business being fairly resilient, even though potentially market headwinds at the moment. Operating capital generation. So this is another measure that they give. It's basically a measure of the cash generated from the business that can be used for things like paying dividends or investing back into the company. That was about 408 million, but this is actually down from 486 million last year. It's still a decent number. It supports the company's dividend policy at the moment and leaves some room for some strategic investments as well. Interim dividend was up to 6.7 pence per share, up from 6.6 pence per share last year. Again, I think this kind of just goes to show that they're like Legal & General. They're confident in the company's financial health. They want to try to reward shareholders in this way because just the share price hasn't really done it in the last 4 years, and these companies seem to love dividends in the UK, and that's kind of how they see shareholders generating a return. And Solvency II ratio, this is another key metric. It's a regulatory metric for financial services firms, especially used by insurers. It measures how much capital a company holds compared to the minimum that's required by law, essentially. And M&G's Solvency II ratio is about 230% at the moment, and it was 223% at the 6 months prior to this. So it's gone up a little bit. The higher the number, the better. Sorry. So that indicates that they've got a stronger balance sheet and a greater ability to withstand any potential financial shocks coming down the pipe. They talked about some key developments and some strategic processes that they've that they've made. The earnings report highlighted some pretty interesting moves that are shaping their M&G's future. It's filled with corporate rubbish, though, Steve. They called it the positive operating jaws. This essentially was when the company's revenue growth outpaces its cost growth, from what I could gather in the report. Operating jaws is a term that we now have to use, Steve, all the time. But yes, in the asset management segment, they achieved positive operating jaws, revenue up about 3%, costs down 2%. So successful focus on improving their operational efficiency seems to be bearing fruit. Some more international expansion. They're making a concerted effort to expand reach beyond the UK. The presentation noted that about 58% of their third-party assets under management and administration now comes from international clients, which was a big jump because it was only about 37% 5 years ago. So about 21% extra. So yeah, diversification reduces the reliance on the UK market. That's a positive, I would say. Actively growing their presence in the private and illiquid asset space. They're doing this for institutional clients. Basically, they've got a stake in P Capital Partners, which is essentially going to derive some of this sort of private and illiquid investment. Another one in a Japanese investment arm as well, which is doing a little bit more of the kind of Asia-style private and illiquid markets over there as well. Interesting to see where that goes. In the call, there was some interesting thoughts from CEO Andrea Rossi. Clear about the 3 strategic priorities that guide their business. Essentially, it's financial strength, simplifying the business, and then trying to grow, essentially. So they highlighted that strengthening of the balance sheet was one of their key pillars, I guess. Reducing company leverage, keeping a consistent and manageable dividend policy. And their message was kind of this overarching, we are financially responsible management team. And that came through quite a bit. Simplifying the business, the focus on streamlining business operations, driving down costs, improving their efficiency. They said that this is crucial for improving long-term profitability, and that we're starting to see that in some of the numbers. And growth, the most positive aspect of their business, Rossi explicitly stated, now we are about growing the business. Record net inflows and the asset management were the major talking point for them, confirming that the company's strategy is beginning to deliver what they were calling tangible results. So yeah, I would say the call was disciplined execution, positive momentum, and trying to move away from the sort of challenging periods that they've had since this split from Prudential. So yes, I had a look at some of its performance. I compared it to some of its peers, Steve. I had a look at Legal & General. I had a look at Schroders as well. So when looking at revenue and assets, Legal & General is definitely a larger player, better top-line revenue growth as well. M&G has a better net margin than Legal & General, but it's pretty slim either way you want to look at it. M&G is a bit more efficient at turning each pound of revenue into profit, but Legal & General has a higher return on equity, suggesting it's better at generating profits from shareholder investment. Valuation, M&G's got a lower price earnings ratio to Legal & General, so I think the market values it probably a little bit, not expecting to see the kind of growth that Legal and General is, and the price to book is quite a bit higher than Legal and General, almost 50%. So I really think the valuation depends on how you want to look at this, and I would suggest price to book is probably the more sort of relatable metric, but we'll see. So yes, I think M&G's market position, they're kind of recognised for having strong active management capabilities and a growing international client base. But I think they've got stiff competition as they move into this, because Legal and General is really trying to do this with its ETF platform as well. And Schroders is obviously the firm to beat in this kind of area. So I guess in conclusion, these were pretty positive, Steve. I thought they were half-year results were decent, clear, positive shift in momentum for them. They're executing on strategy. Turnaround in net flows was good to see. Strong operational performance was good to see. Good to see the robust balance sheet, or the balance sheet becoming more robust. And I think it's in a really, really competitive landscape. And I would be interested to see how it moves from here. Not interested enough to watch list it, I must admit, Steve, because I find these kind of companies incredibly difficult to assess. But I hope that was useful for people.
Dividend investors like these companies, don't they? And it's not hard to see why. They come with massive great yields. A lot of them have pretty good track records of paying out, and being kind of financials or financial services companies, they just seem to have money swilling around all over the damn place. They seem to have balance sheets that are in pretty good shape if you try and read them in a kind of conventional way. And so I get it. If you look at where you typically find big dividend yields, you find them in tobacco companies, obvious risk there. You find them in REITs where the risk is less obvious, but the snag is they don't really grow because they have to pay out all their cash, and they always have massive leverage balance sheets, and they have to try and work out what to do with that. And if interest rates go up, they're in trouble. And most people, I think, can figure that out. You find them sometimes in house builders, which are sometimes victims of inflation and higher interest rates as well. And you find them in insurance companies. And it's always kind of interesting to think about why a little bit. I mean, I suspect in a lot of cases, people think with these things there isn't really that much of a risk because they can't quite work out exactly what it is. And we've kind of, as you said, half of their business or one side of their business is kind of life insurance, and that's definitely a risky kind of business. You have to price a policy now that will run for about 30 years or so, and then you'll find out how much it cost you over that period of time. And you can't change the price if things get more expensive. These kind of long dated contract things are tricky in the way that something like car insurance or even health insurance in the style of United Health is not. That reprices every year. So if you find something that got expensive, you can always push prices higher the following year, assuming that your state regulator doesn't get in the way like they are with Florida wildfires at the moment. But that's a different kind of issue here. Just to check, what PE ratios do you have on Legal and General and M&G here? Because I'm looking at data that's clearly out of date, by the way, because it only stops the end of 2024, so it doesn't include H1 in this case. But it seems to think that 2024's earnings per share, net income, and so on were negative, but presumably that's the result of some weird, unusual distorting thing, not just the company losing money. But I'm interested in where you've got either of those two as PE ratios at the moment. Did you say it was lower than Legal and General at the moment? I forgot what you said there.
Yeah, so I was using forward P, sorry. So forward P, I think, was 14 off the top of my head. I can't remember what Legal and General's was when I looked at it.
So both trailing PEs are currently a mess. Legal and General's is about 50, and I think M&G doesn't have one. So forward is definitely a better number to use in this situation. I'm interested that it's kind of cheaper. I mean, there's two businesses going on there. One is an asset management business, which in a lot of ways is kind of nicer. The downside being people can ask for their money back, as you point out. They had some kind of outflows fairly recently. So it's sort of when you think about ways of setting up financial institutions or financial services businesses, there's kind of three models, I guess. One is a bank or something like that, where you kind of borrow people's money but then go and invest it. But the trouble is they can ask for it back at any minute and you have to pay them interest on it. And then kind of better than that is, I guess, an asset management business where you take people's money, go and invest it and generate a return, and they pay you to do that. But the downside is they can still ask for it back. And by one way of looking at it anyway, the best model is kind of insurance model where they give you their money, you go and invest it, and they can't ask you back unless their house burns down or they get some sort of horrible illness or something like that. So there's a lot to like about these kind of models, I guess, but investors do seem to think there's kind of big risks involved here. We'll get into what those kind of might be in a little bit, but very high Solvency II in this case. Legal & General also has a Solvency II surplus. You expect they would, and you'd certainly hope they would, because that's kind of the condition of doing business. And we'll come back to Legal & General's in a little bit, but they seem to be in reasonably solid shape, M&G. I also find this a bit too opaque, maybe for reasons I'll talk about in the L&G bit, but to my mind, yeah, interesting to think about how these things work. I think a worthy competitor that doesn't get talked about very much, and maybe worth it for people who like these kind of high yield investments.
Yeah, I think that's probably the only place that I would really consider it, is if I was looking for a massive amount of yield. I think my big issue with it is just assessing it. I think from a even if I was going through my risk checklist, I wouldn't be comfortable answering the queries on it. The financial that you get out with these kind of insurers, the life insurers, the asset managers, are so complex. They're very difficult to understand what they're doing. And I think it is just so out of my wheelhouse to understand these in the detail required to buy these things. So, I mean, the only thing I would consider if I was buying them was if I was solely focused on high yield only and nothing else mattered. And I think we spoke about that before, Steve. It's a fairly silly way of investing.
You've been watching a segment from the Playing FTSE show, brought to you in association with our favourite broker, Trading 212. For the full version of the show, check us out on Spotify, Apple, or wherever you get your podcasts. And if you open a new account with Trading 212 using the link in the description, there's a free fractional share in it for you. Just make sure that you use the code FTSE when you sign up. Terms and conditions apply, and do remember that when investing, your capital is at risk.